Well, hello, this is Michael McIntyre, and I'm with the estate planning team, and here to talk to you about the Deferred Sales Trust. I'll be with you in just a minute. Do you want to do an introduction, or how would you like to do it?
Just a really quick. So my name is Mark Kennedy. I've talked to all of you on the phone. I'm a wealth manager. I own an RIA firm, registered investment advisory firm up in the Calabasas area. I got involved in the Deferred Sales Trust a couple of years back, and we didn't really do any deals at that point. At that point, I didn't really understand the structure or strategy. Consequently enough, we had a current client of mine who's been a client of mine now for several years, who had a 50-unit apartment building that he needed to sell, and this happened last year, late last year, and I ran into the Deferred Sales Trust again. And this time I was a little bit more intrigued, because I found out a CPA in our building was actually a trustee for the Deferred Sales Trust, and he's been doing dozens of these deals over the last couple of years and really helped his clients. So I wound up presenting the Deferred Sales Trust concept to our client, got our client on the phone along with Bob Binkley, who was one of the original creators of the Deferred Sales Trust, along with the Campbell Law Firm out of Missouri, who is also the creator of the trust itself, and the trustee, and we got them on the phone, and we navigated through the sale, and that closed in January. So now this client is in the Deferred Sales Trust. It's about $4.7 million of assets that we ended up with after real estate commissions and everything, and that's being actively managed right now. The thing I really liked about the Deferred Sales Trust for that particular client is it gave the client a lot of flexibility. That client didn't need the income, and he didn't really want to go back into real estate right now because of some of the low cap rates and maybe the overvaluations. So he wanted to be able to re-enter that real estate market at a later date if he chose. But in the interim, he didn't need the income because he has income coming from another apartment building. He also has a lot of IRAs and pension plans that he's receiving income from. Him and his wife both had successful medical practices, so they have to start taking required minimum distribution on that. And so we wanted to defer that. And then what we were able to do is in the Deferred Sales Trust structure, we set up something called a DST Plus. And with that, it removes all those assets from estate tax, which also means that it has creditor protection and asset protection. And in addition to that, we were able to defer those payments to him for 3 years, to him and his wife. So that worked out great. So now it allows him to take his required distribution and not be impacted by a forced distribution from an apartment complex or another piece of real estate of income he doesn't need. So we were able to control the tax a lot better. He was able to defer 100% of the gain. And also the recaptured depreciation, he was able to, I believe that gets deferred also. Is that right, Michael?
That's correct.
Yeah, so we were able to defer that as well. So good things. So that's why I wanted Michael to do this call. I tell people I'm kind of more of the nurse. Michael is more of the doctor, along with other members of our team that have done many of these transactions. And I know some of you on the call today have some sellers right now in play that are currently listed, and this could be a fit for them or a potential listing coming up. I know that if Jim's on the call, I know he's got a client right now that's selling a building down in South Orange County, but he's 2 weeks out from lifting contingencies, and once contingencies are lifted, typically we cannot do a Deferred Sales Trust transaction. And I know I reached out, Jim, if you're on the call, I did reach out to David, left a voicemail message, haven't heard back from him, so maybe you can kind of help circle back with me and him on that. But anyway, I'm going to turn it over to Michael and let Michael kind of take the rest of it. And I'm sure many of you on the call today have questions, and maybe you can give us some potential scenarios that you're running up against or that you have in the past, and we'll see if this could be a potential fit.
Yeah, wonderful. That was an excellent introduction, Mark. It always pays to have beautiful, wonderful anecdotal experiences from which to draw upon to share with this experience. I think the last year, as you were mapping things out, I can just think it's been such a dynamic year in change that you have to be available to be looking for options for your clients and success. There might be, whether there's an inventory issue, a problem with supply. The one thing that is really constant is a lot of sellers are very, very tax sensitive. In legislation right now, it's been working its way through sort of the snake here in California, is legislation to have a surcharge, a charge on a 1031. Be aware that that may actually happen. California certainly has also some legislation to increase taxes from 13.3 to 16.8. In addition, there's a proposal for a wealth tax. When you're over 30 million, you'll have to pay 40 basis points on every dollar over 30 million. So your clients, your sellers are very concerned about that. There's also estate taxes. Those three things that we talk about are somewhat of speculation of whether that'll happen or not, but there is a supermajority of one party in this state, and there is a real problem with unfunded pension liabilities, deficits, and other things, and there's got to be some way to pay for that. So something's got to give, as the saying goes. And so what you need to be is you need to be ahead of the curve on a lot of these things. 1031s also are a challenge for people who are aging. They get tired of the, as they say, the tenants, toilets, and trash, and want to move on to what Mark was saying, that his client wanted to move on to kind of the cruises, clubs, and cocktails of their life. And so this structure can help with that. Also, it can help with the seller when they want to maybe buy real estate, but not within the convention of the 45 days and the 180 days that is required under a 1031 itself. So these are things and flexibilities that we'll be going through. We hope that we can provide some core competency, which yours is problem solving. And so this is a big problem that clients face. And we'll be going through exactly some examples here on how much taxes really mean to sellers. But let's walk through a transaction and talk about how it works. As Mark was saying, we have two programs that should be very interesting for you, for your sellers, for your clients. One is called the Deferred Sales Trust, which we'll be talking about. The other is called the DST Plus, which Mark mentioned. The Deferred Sales Trust comes out of IRC Section 453. You commonly know that as an installment sale. Sometimes you call it a seller carryback financing. That law is nearly a century old. That's how old it is. And the basic idea is that you're going to be able to sell an asset and exchange the asset that you have, the property that you have, for a series of payments. Okay, and we're going to go through how that works. Let's walk through an example. Say you have a client and they have real estate. They could even have a business that they want to sell. They could have a collectible, any number of these things. So this swim lane is much bigger than a 1031 and more flexible than a 1031, and recasts the cost basis on the new purchase, and we'll talk about that. So the seller is going to do is they're going to ultimately engage. We are a law firm, accounting firm, and marketing organization, as Mark pointed out. And what we do is that we engage with the client on a contingency agreement. There's no retainer up front that your seller will pay. It's purely based on performance. And so the seller would become engaged with our law firm, and then the trust would then be formed by a trustee. As Mark was saying, that he was had a connection with one of our trustees who's right there in the valley there. And so the trustee then forms the trust. The client, the seller, your seller, is going to name the trust. Okay, so if they want to call it the LA Trust, I could call it that. We form what's called a Missouri Business Trust at this time. And then what happens is that the seller sells the asset to the trust in exchange for a series of payments. And then what happens is the trust sells the asset to the buyer. This is very similar to the way a QI, a qualified intermediary, works on a 1031. Remember, they hold that asset and the funds avoid what's called constructive receipt, which means that the funds are not sent to your seller, but sent to this QI who's going to hold the funds. Think of it kind of the same way, but the holder of these funds is going to be the trust that the seller names. At this point, Mark sat down with the client and just said, hey, what's suitable for you? How are we going to invest and make those investment recommendations as a fiduciary? He's responsible, and as an investment professional, he set out an investment management for the client, for that seller. Now, if that client, that seller said, hey, Mark, I think I want to put some money into real estate, they could put up to 80%. And we'll go into that in just a minute. So they could go back into real estate at a later date if they wish. Then the cash flow comes back to the seller in the form of an income payments. They could delay that income. They could increase the income. They are the lender to the trust, the LA trust, and they can determine how quickly they want to have payments come back. Most clients that we work with take a 10-year promissory note, and they renew it at the end of 10 years. They may delay income, they may increase income somewhere along the way, but ultimately they get to determine how much cash flow that they want to have. So this is a great retirement plan, but also makes for very good tax engineering. Taxes, as you know, are based on progression. The more money you make, the more taxes you pay as a percentage. And the reverse is true as well. If you reduce that income payment or engineer what you just need instead of what you need to pay, is very, very important. We safeguard the funds very, very carefully under a system called DACA. That stands for Deposit Account Control Agreement. We use SunWest Bank here in Southern California to ensure that we have 3 parties that sign. That is your seller, we call them the note holder. And let me pull that back up again. I was a little too trigger happy there. Is that the seller, what they're doing is that they sign, the trustee signs, and the verification by an FDIC bank is then done. And then funds can be deployed. Mark has worked with our DACA arrangement so that the funds could be deployed. And so that is a safeguard that the trustee cannot just run off with the money. Very, very important. I can't, describe that to be important, but all of our trustees are very, very good background, people that accountants, attorneys, very trustworthy people. But you have to have a system for this to safeguard the money. Very, very important. Let's go through what maybe a seller goes through when they list the property from you, list the property. Sometimes they won't list the property because you're going to tell them, hey, this property is worth $5 million based on cap rates, based on the value. And you, as a real estate broker and a professional, you know these numbers. You know what a property is worth based on, income, cash flow, location, all of these kinds of things. CoStar has a great, valuation system as well for this, and easy to, not perfect. It's somewhat of an art, and that's what you guys are. As commercial realtors, you know value, you know location, you know this. But here's the problem, is that a client like this, with a $5 million sale and $1 million cost basis, has 20% that's going to go away to federal taxes. Then there's the state of California, which is currently 13.3. Maybe it'll go to 16.8. I don't know. Then the next one is Medicare tax, which is 3.8. So your client writes a check for almost $1.5 million just in taxes. That's even before they pay your commission. So at the end of the day, this seller has, with commissions and everything, may net less than, or close to, or maybe even less than $3 million. Now, if you're that seller, do you want to do that? Ask yourself, would you do it? It's at the close of escrow, that seller is paying 2 commissions. right? One to the governments and one to you. Which one do you want to reduce in front of that client? Do you want to reduce your commission, or do you want to work on reducing the government's commission? I suggest that you work on reducing the government's commission, and that commission can be higher than this. And or what if there's a surcharge on 1031s? Does the client want to do a 1031 if the state enacts a 3, 4, 5, 6%? Now, you might say that's unusual, and you would be wrong, because Pennsylvania already does this, Maryland does this, and several other states that have immigration issues, meaning that more people are leaving than being born or coming. Like those states have had decades of negative growth. California's starting to see this right now and seeing this negative population. New York and New Jersey are seeing huge amounts of people that are leaving. We're dealing with this as a national firm. Much of our business is in just a few states. New York, New Jersey, California are some of our biggest states where we do most of our transactions, California being the biggest one. And we're seeing lots of people that are moving now. And this is an important thing. So you need to have, if you just have had the 1031, you need to be open to newer ideas and to solving these problems. Again, your core competency is problem solving itself. Let's talk about how we know it's legal. We've done this structure for over 25 years. We've done thousands of transactions. We've been reviewed and audited by the IRS. The last one we had was in downtown LA. And we were really fortified about the conversations that we did have with the IRS. The IRS knows that this works. The IRS's biggest concern is that we would move money overseas and the money would disappear, but they know that they're going to get paid, and they know that it's a legal structure. The client, we do a very interesting thing. Not only does our law firm do everything based on contingency, performance, and no retainer upfront, but they also, at the close of escrow, if your client is ever audited, whether it's the Franchise Tax Board or whether it's the IRS, we represent, our law firm, accounting firm will represent your client in the event of an audit. That's quite a bit of contentment that your client will have in knowing that they're going to be taken care of. I know of no other, in my nearly 37 years in this financial services business, I've never heard of a law firm that works that way. There's usually a retainer, and then that's it. There's no implied warranties or representation after the structure is done. It's additional fees. So this is very, very unusual, at least in my mind and in my experience. Maybe you have that same experience. We also have national law firms that we've worked with that are note holders, our sellers have worked with, that they can go talk to. They can get advice after they're engaged with us. We can turn them over to a law firm that may write them. They may request, your seller may request an opinion letter. These are opinion letters that have been written and are called will opinion letters. It's a very high level of opinion that they believe that it works. When a client gets an opinion letter and the IRS says historically in the past, when they say that you owe a penalty, showing the opinion letter of a substantial recommendation has in the past historically not had them pay a penalty for it. So some clients may want that. They may want to have that peace of mind that happens. DST minimums. So the smallest deal that I think really makes sense is if the client has about $500,000 of a capital gain involved. We do a 10-year note, and at the end of the 10 years, they can renew again. So the continuity plan is the client goes for 10 years, can renew. If there's death along the way, then they typically take these promissory notes in a living trust or a flip called a family limited partnership, and then the continuity occurs at that point where the child, the heir, would be the lender. So if Mark's client were to pass away, both of them were to pass away, likely go to the children, and the children would continue to defer the tax as such. Or in Mark's case, they wanted it to skip over maybe a generation, or maybe they wanted to get it out of the estate entirely, their estate, and into their children's estate, and the income would be in their estate. So this is an important, very, very important thing as clients realize that the sunsetting is going to happen in 2025, like we talked about, estate taxes, where it's going to go from currently the 11 million to as little as 3.5 million per person. And it starts out at 35% and then goes up to 55 on the estate taxes. So all the net worth, that everything that you've developed can just poof and go away within a short period of time. So clients are very, very concerned about that. What does it cost us to create a trust? And so there's the tax attorney fee, and that comes out of the principal. So that's 1.5% of the first million, and then 1.25% on the subsequent million. And then at over 8 million, it's a flat 1%. That provides that audit defense like we talked about that the client's getting, and it's all a contingency. So if the deal doesn't happen, they don't like us, whatever happens, they don't pay us. The consequence of paying the IRS is a lot more though. So we tend to do pretty well there. So we're very confident of that structure. It's worked for nearly 25 years as we've done this structure, or over 25 years. Trustee management on the smallest of accounts, less than 2 million, is 85 basis points. That drops by 10 basis points for every 2 million, with a max out at 35 basis points as the smallest fee. So it can be anywhere between 85 and 35 basis points, depending upon the size of the transaction. There is an annual tax return that the client pays on the trust to have the trust return done. It's a standard 1041 filing. We can give it up after the first year. Remember, we have to have standing with the IRS in order to provide that audit defense. But after that, if the client wishes their own CPA or tax professional to do it, we're more than happy to hand that off. And that means money for you. That CPA can be an excellent source of referrals for you. Typically, you look at a CPA or a tax professional as your business prevention department. We look at it just the opposite way, is that we look at that as a great opportunity as well. And somebody remind me before we end the webinar to talk to you about how we can help you prospecting in CoStar before the presentation ends. So the client should be on the smallest of accounts, should be all in with a competitive 150 basis points, 1.5%. So that's going to be an important feature. So I just want to talk about protocol for just a minute on scaling a deal and how a deal happens. That the deal happens with you perhaps even becoming a member with us. We're a membership organization, so we encourage you to join. It's for the high price of $0 that you will pay to becoming a member, and you'll be using Mark's partner code itself to join. And so Mark will tell you about his partner code in just a minute. So we encourage you to do that, because what we look at for a process is for you to be able to be the orchestrator of the deal, to be involved in it, and to be part of Mark's network of referrals and training and other things like in CoStar and other things that we really hope that you would be able to take advantage of. We help scale the deal, we help closing the case, and then Mark investing the funds and helping invest the funds, and perhaps maybe investing the funds means sometime down the road that they might buy real estate sometime in the future if they want to. Maybe they want to take off the table right now, get out of real estate, maybe permanently, maybe just for a season. We certainly have had clients that have sold property. I'm thinking in 2007 and 2008, when of course we all have amnesia that real estate markets can go down, but I'm old enough to remember that the market did go down in 2007. Some of those clients sold their property, had the foresight to sell that property, and then they were able to buy it back by 2011, 2010 for a lower price. So that's always nice. Let me walk you through how that might work. So what we would typically do is if the client had $4 or $5 million in the account, let's say it's $5 million, they could take up to $4 million to purchase real estate under our structure. And the way that would work is that the client would then, we would set up an LLC, and one of the investments that the trust would make would go into the LLC. And in doing so, they would recast a new cost basis. This is substantially different than the way that you would do it with a 1031. The 1031, you have to up purchase. If that property was purchased for sold, I should say, for $5 million, and you had used all of your depreciation, in other words, your depreciation runway as the seller has completely run out, you actually have to up purchase on what's called the up leg in order to get additional depreciation. And there's a limit to that because of diversification and purchasing and mortgages and all that. So there's a limitation on that. So if you purchased a $6 million property on the up leg, then you could depreciate $1 million. Here's the difference on the deferred sales trust, is that this buyer establishes a new cost basis at $4 million in that $5 million transaction. The $4 million begins depreciation at $4 million. You heard me right. It's $4 million for that depreciation. So they can begin to depreciate all of the $1 million that Mark is managing. It could shelter it with the depreciation on an aggressive depreciation. So they're actually pulling their money out that way. And you sold them 2 properties. You sold them the $5 million, you sold them the $4 million, and let's say 10 years down the road, they sell that property, they run out of depreciation on a 1245, an aggressive depreciation schedule. You're going to sell them that property again, and then they're going to want to buy another property again with capital, and they can defer 100% of the capital gains and rinse, wash, and repeat. So that's 4 properties in about a dozen years from one client. Pretty cool. We can do a whole webinar on this. I only scheduled a little bit of time, but that's a fantastic opportunity to learn. If nothing else, you're able to talk to clients, and we could talk to some of your wealthiest clients, and it gets them stimulated about some different opportunities and some different options, which is always good for you. So I always say in real estate, options mean closings. Options mean closing. So this is kind of the structure here on basically how it works. We set up this LLC, and it winds up being one of the investment options with a share and a preferred relationship that the trust has with the LLC, and your seller winds up being the managing member. Real briefly, I'm going to open it up to questions here in just a minute, but I just wanted to also say that we can resolve or solve their estate taxes by something that's called premium finance. Again, one of the things that is really on your client's mind is, how do I resolve this estate tax problem for my children for a benefit? And this structure can do that as well. Mark's familiar with this structure on how it would work. Lastly, I just wanted to thank you for coming. Let me open up your microphones here. And...
Yeah, really quick, Michael, too, while you're opening everybody else's microphones, that last slide you showed is on a traditional deferred sales trust, but we did a version called a DST, or Deferred Sales Trust Plus, with my client who had the apartment building. So with that, that's automatically removed out of the estate with that type of trust. What Michael was showing you is on a traditional deferred sales trust. There's other techniques that we can use to remove it out of the estate, but that automatically gets removed out of the estate with the DST Plus.
That's correct. And not everybody may want to do that, maybe. And others we have, and they may still have, even with removing this portion out of their estate. They still may have estate they may have estate tax exposure. That was a mouthful. That they might be very, very concerned with. Their net worth is so high that they are very, very concerned about that. And real estate is very illiquid, particularly when you do at death. You file a form called a 706 form. The 706 form, you've got to pay the taxes within 9 months of filing that. And imagine, worst case scenario, maybe you get into a bad bear real estate market. Some of these properties are very difficult to sell, and maybe the planning starts now for that. Super important that the clients want to hear that you're part of that planning process. The wealthier they are, the more they're going to be wanting you part of that planning process. And obviously, you're solving these incredible difficult problems that they're facing. And one of the things that is pretty amazing is that most of your clients may not know about our structure, even though it's 25 years old. We've been around, we've done lots of transactions, we did billions of dollars of deal flow last year. They're not aware of this. So this puts a cape on you, I think, as a superhero in front of all of these clients. And they really are going to enjoy a new relationship, and you will too, with these clients for generations to come and for many, many sales to come. One client can produce quite a bit of sales for you by just doing, the right kind of thing. It creates kind of a sustainable model. Okay, let's just open it up to questions here. Again, my name's Michael McIntyre. I see Sean and Jim and Bill and Barry. So open up your questions.
Michael, this is Sean.
Hi, Sean.
The question is for the DST. Can it be combined with a traditional 1031 exchange? Let's say my client, will net $10 million and then $5 million, put in the DST, where there is some estate planning involved, which means that the fund can be used by the trustee or the successor trustee of the trust, and then the other half, that is traditional 1031 exchange, can it work in parallel for someone? Let's say that 10 million or 5 million is split in half that way.
Yeah, we call that a bifurcation. So they could do part of it in the 1031 and part into the Deferred Sales Trust. Absolutely, we do those all the time. Sometimes we do those where sellers face what's something called mortgage over the basis. I was just working on a case today where the mortgage is higher than their cost basis. They probably refied, probably did some aggressive depreciation, and in doing so, they need to do a 1031. They have to do a 1031 in order to not have recapture on that differential between that. So we do it in those examples. We also do it in examples like you were just describing, where the client wants to diversify out and step down maybe a little bit in real estate and maybe find a better cap rate that you could find for them. Yeah, we can work with you on that as well. Sure.
Okay, thank you.
Great question. So we have Jim and we have, let's see, Bill and Barry. Any questions that you guys have?
Hi, this is Barry. I have a client who doesn't have any heirs and has a high net worth. So I was thinking about this for him as I sell some of his assets. I'm trying to, maybe you can help me with that. Why would he be interested in doing this? If he passes before his wife does, or I know he has some nonprofits that he's offered to, bequeath, whatever the case would be. So can you help me with that at all? Maybe I can.
Sure. Sometimes as we age, we get tired more, we get irritated a little bit more with the tenants and the toilets and the trash. And if he's at that level where the management, the day-to-day management is something he doesn't want to go through, or he really thinks on a long-term view that he might have peaked out on real estate. Those are two things of consideration. And then, of course, the third one is estate taxes, if he really has an issue with it, even though he has no heirs. Believe it or not, some of the biggest cases that we've worked on are people who have no heirs, but just have an issue with estate taxes. Okay, and so a philosophical disagreement with that. So they plan accordingly, ways that they can reduce that footprint for the IRS. And so those are different things, or perhaps he has foundations, charitable remainder trusts, or other things that he wants to fund foundations or charities at his and his wife's demise itself. So those are all conversations that we certainly could have. Do the right thing.
Great, thank you.
You're welcome. You're welcome. Okay.
Sean again, Michael.
Sure.
Beside of the deferred sales trust, you also do. That's why I hear the CRT also for people that want to, actually contribute to some charity, actually, beside of the tax, planning purpose.
Yeah, Mark does those. Does the investment side for CRTs, and we do have other California attorneys that can help draft those as well.
Yeah, and Sean, I have on the CRT end, I work with a couple of attorneys on that end as well. And I know, Michael, you've got extensive background in CRTs. Am I correct?
I've done a few.
Yeah. So maybe just real quick, I mean, not spend a lot of time, but just like 1 or 2 minutes on the difference between that. So Sean understands how that really is different from the deferred sales trust.
Yeah, the CRT is the charitable remainder trust, and it has different iterations of it that do different things. There's lead trusts, there's different things that would happen, but essentially you have partnered with a charity, and at your demise, typically in most of the trusts, there are variations of this. Your corpus or principal would go to a charity at your death, typically, is the way that it would work. For that donation of today, you're getting a tax benefit for that gift, okay? So depending upon your age, there's an annuity table that basically calculates your average life expectancy, works its way back, and then you get a deduction in your income. The deferred sales trust has no partnership with any charity. It is 100% your heirs. You are not giving it away, and you're not getting a tax deduction on that. If you backtest any of these CRTs, you have to have a pretty good philanthropic or charitable intent in order for it to be something that is worthwhile. I have found over the years that until you're at a certain net worth level, most people are not willing to give it away. So the clients that I worked with had pretty substantial net worths, and they didn't want either their children or they wanted to give it away. They felt that their children and their grandchildren were well taken care of. They were taken care of, and so they felt like they had the 3 generation that was taken care of, and they didn't want to take care of them too much. We all want our children to struggle a little bit, otherwise they don't turn out so good. So hopefully that's a good summary of the difference.
Did that answer your question? Okay.
Yes, it does.
Great. And I wanted to also, Michael, we got Esteban on. He can't, for some reason, I guess, use his microphone. So he had a question. How does it work with multifamily members in the trust? So, we had talked about, Michael, drop and swaps, and maybe you can kind of tell everybody that kind of terminology that we use and the issue of having more than, 3 or more people inside of a corporate structure with a 1031 exchange, and how the deferred sales trust can resolve that. And then also what if one of the members wanted to do a 1031 with their portion, and the other two people in that partnership wanted to do the deferred sales trust? Could that be done?
Yeah, excellent question. So the 1031 is designed primarily for individuals, not for entities. So when you get into larger than 3 on an LLC, any partnership, any S Corp, any C Corp, you have to dissolve the entity, and then, as Mark pointed out, very well called it the drop and swap. So you drop the corporation, you drop the entity, and then you swap it. Well, this is the problem with the drop, is that most articles of organization will require a 100% agreement to drop it. And there's always that one guy who doesn't want to do it. There's always the general partner, maybe in a partnership. They're not going to want to do it. They have a vested interest, or maybe they just don't like each other, and they'll do just the opposite of human nature, right? So that becomes a very contentious issue. And in accounting, at that point, we stop being accountants and we become therapists for these kinds of relationship, and it's not very fun. I can attest to. So the other thing that the Deferred Sales Trust does, it is really the olive branch for everybody, because there's not a required drop and swap. Your divided interest, whether it's a partnership or whatever it might be, is what you're going to sell to the trust. The trust then can do the various different filings, one on a C Corp, which, by the way, a C Corp is particularly troublesome, because when you dissolve, when you drop the C Corp, you have retained earnings, and you've got capital gains on the C Corp as well as you individual, so it's a double taxation. So that's particularly ugly. What we can do is we can file a form called an H-338 election on that C Corp or on a partnership. There's another form for that. I won't bore you with that, but we're going to convert it into an asset. It's a one-time conversion that we can do, but because the trust bought it for, let's say, 10 million and then converts it for 10 million, it doesn't have a tax consequence, and the conversion may or may not trigger. In most cases, our lawyers can help them not trigger that taxation oftentimes, and then they defer all of the tax that's intended on this. So this is, and each individual gets their own trust. So there's no commingling. So as Mark pointed out, one person could do a 1031, another person could pay the taxes, and yet another could do the deferred sales trust. Doesn't have to be the three musketeers, one for all for one. They can all do and go their separate ways. So you can see how this can be the great olive branch that you need to do in order to maybe this is the problem that is needed to be resolved. I often deal with family members that have great conflicts, I see them on the webinar, and they don't like each other, and they're going to do just the opposite. And when we explain this, it diffuses everything. When we explain that very good point. And so thank you, Mark, for pointing that out. It oftentimes you need to be, as that outside person, you need to be that peacemaker in the situation, and the deferred sales trust is going to add value to it. Again, you got to put on the superhero cape there, and everybody gets to do what they want to do, and you, of course, get the listing and the sale. One last thing before we go is CoStar. I'm sure all of you use CoStar to prospect, to deliver information, and even prospect now. So in another webinar, another presentation, we can show you certain key points once you're a member of a estate planning team, and Mark's going to give you his partner code in just a minute, is that we can feed you information real time and get your CoStar trainer representative. And we can do a webinar to show you how to begin prospecting using key components that are in CoStar right now, like the age, the real true age of the seller. Yes, CoStar knows that. They know the true age of that seller, the size of the mortgage, how long they've owned it, a number of things. We can take the farm area that you're working in and you will be delighted to see how many people are actually, prospects for you right now. We can begin a drip campaign on them. We've got letters, marketing, and flyers that you can begin to email those sellers about this. And I'm going to tell you that will differentiate you completely from your competition. And one of the challenges right now is inventory that you have. This will create inventory. You will get the listings. This is going to close your deals faster because it's all about acquisition and getting those listings and closing that deal much, much faster than you've ever closed. The biggest headache that these people have sometimes is that I hear from commercial realtors all the time. The seller is unrealistic. Okay, perhaps maybe it's the government that's unrealistic, that they're feeling, that they're saying. Maybe they're not articulating it right. That's your job to unpack that on their behalf. And so by having the Deferred Sales Trust, you can take out 37.1% of value. Is that the difference between a sale or not a sale? Maybe they are unrealistic, I don't know. But this certainly can bridge this in a lot of different ways, in a lot of different pieces. Mark, tell us about your partner code, and I think it's KWMGMT, right?
Yes, I believe that is correct.
Okay. So
let's look here. I think that's it. Yeah, KWMGMT.
So KWM as in Mary, G as in George, M as in Mary, T as in Tom. Now, if you'll write that down right now, that is your free partner code to sign up with Mark. And you'll be going to
put that actually in chat too.
Okay, wonderful.
Well. So that'll be all.
Also put in the link for the myept.com. So here's where you're going to go. You're going to go to myept.com, like my early pregnancy test.com, myept.com. And when you go there, you're going to click on the quill on the right-hand side. It's a blue quill. You're going to click that on, and it'll begin to curate questions about you, and then it'll ask what your profession is and all that. After that, it's going to ask for a partner code. That's where you're going to enter the KWMGMT, and Mark is putting in the myept.com website right there. Let me see if I've got it here. Thank you. There we go. So you can join me on there, and Mark, and thanks so much for joining today.
Yeah, so real quick, Michael, before we go, we have a couple more minutes, just real quick. So really quick before we go, I want everybody to understand on the call too, to do the Deferred Sales Trust, correct me if I'm wrong, this has to be done or set up prior to contingencies being removed. Can you maybe expand a little bit more on that?
Yeah, so the concept is called constructive receipt. Mark, if I hand you money right now and you take it, or you could have taken it, that is constructive receipt. So once contingencies have been removed, it's effectively a sale by the IRS. So if all the contingencies have been removed, we normally go into a constructive receipt. There is one exemption, and that is a QI holding the funds at a 1031. So if you've got a closing and it's closed tomorrow, we do have a favorable list of QIs that you can send the money to, and we can rescue the 1031, where we have what's called a defeasance agreement there. We do that, and the QI, we have a list of QIs, qualified intermediaries that can do that. But by and large, you're absolutely correct, Mark. We got to have the structure in place. And people always ask me, commercial brokers ask me, when's the best time?
Right. When's the best time to set it up? Right.
Yeah. And I say as early as possible. That's my answer. Because my attorneys get very grumpy when I tell them that we have a 1-week close and it's during tax season. Okay, they're not real happy with me. I'm not their favorite person, and then I'm whipping them to get them going with this. So as early as possible, because your client will pay the same fee whether they get advice for 1 month, 2 months, or 5 months or 1 day prior to the close. We want to give that advice to them as early as possible. And
the fee is zero for that advice, by the way.
Right, until they close, right? Then we do charge them. So they want to be well advised on all of that. And this is going to open up, the more that you have time, the more it will open up other opportunities for you as well for connections and referrals.
And just really quickly on that contingency removal, let's say we got somebody that's in play right now on a deal, and they're only like a week before contingency is being removed. What would be the best way to handle that, knowing that, you know, we probably can't get this done within that time frame? What would be the best solution for the broker and for the seller? Would that be to extend out the contingency period with the buyer?
Well, based on the hypothetical that you're giving me right now, we've got two different ways of doing it. One is extend the time frame, which is the Auckland's razor, the simplest thing to do, right? The second thing is, if we can't get it done, we just can't get it done, then we're going to need to go to a QI at this point, which is going to cause the client additional fees and expenses at the QI. We don't want to do that, so the simplest thing to do is to extend that out a little bit, and then that gives us a little bit more time itself. All
right. Okay, great. Well, thank you, Michael. Really appreciate it. I hope you guys were able to pick up some good things today, and I think this is a real boon for those of you who maybe have had deals in the past that you couldn't list because the seller was either price unrealistic, and now that you can show them how to save a lot of immediate income tax, that could really help you negotiate down that price to more of a realistic number. And also, I think it helps out those of you who have had sellers in the past come and say, I just don't want to sell because of taxation, and I don't want to get into a 1031 or a 1031 Delaware Statutory Trust or an opportunity zone. And this is a way that you can do that without having them have to re-enter back into a project or real estate that maybe they don't want to buy. It's interesting, just real quick story before we leave. I have a friend of mine that's also in the business. Years ago, him and his wife were doing a 1031 exchange, and they exchanged to a property in Phoenix, Arizona. And because of all the time limitations and because of him trying to run his own firm, he didn't have a lot of time to do the research necessary, and they gave him the rent roll, and he kind of went off that, and they bought the property. And about a month after he bought the property, 60% of all the renters moved out. So what they found out had happened is that the seller had stacked the renters inside the property illegally, and then they were using that on the rent roll. And then once they sold the property, they all moved out. And so, my friend and his wife were left with this kind of albatross, and it took a couple of years to move through that and litigation and everything else. So the problem with the 1031 is that it can force a seller to get into something that maybe they don't want, and especially in a low cap rate environment that we're in now, where the deferred sales trust can allow them to exit out of that, get brand new redepreciation all over again, even get accelerated depreciation on the interior contents and things like that, and go into a brand new purchase. So that's part of the great thing about the deferred sales trust. The last question, Michael, and then we'll go, is what is the repurchase percentage of the trust that can be used to go into real estate? So in other words, how much of the money that's in the deferred sales trust can be used to repurchase real estate on a partnership with the deferred sales trust? And then how much has to be left in the managed accounts?
Yeah, I like the description that you were giving. One person calls the 1031 the shotgun wedding approach to purchase. And that 180 days happens so fast, and you don't always get good due diligence done. But up to 80% of the proceeds in the trust can be used to purchase real estate, a business, or other things that have business purpose to them that they can purchase, and they can get all the benefits from that as well. And remember also that the deferred sales trust is not just for real estate, like we said in the beginning. It's also for businesses. We've also done, highly concentrated stock positions that are publicly traded, other things. So you'll be helping out the client as the commercial realtor, help them out in a big way. Oftentimes when people sell their real estate, they're oftentimes selling their business along with it, and just, going to cruises, clubs, and cocktails of life. Thanks so much, everybody, and thanks, Mark, for sponsoring it, and look forward to working with you in the future.
Yeah, and I'll reach out to everybody that was on this call today over the next couple of days, and we'll talk and see if we can help you out in any way.
Great. Thanks so
All right.
much. Take care.
Thanks. All right,
Bye.
bye-bye.